Welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me is my colleague and partner, Paul Tepsich, the founder of High Rock. You may see that picture. It looks like a little bit like Chuck Schumer, but that's really Paul. And also with us today is our certified financial planning professional, Bianca Tomlinson. Well, we have three investment models from which we apportion a percentage allocation to each client portfolio based specifically on our goals, the time horizon required to achieve those goals, and our tolerance for risk and the potential for volatility that may be required to get over in achieving our goals. All this derived from each of our wealth forecasts. Our investing strategies and asset allocations then become a function of our wealth forecasts. Now, in our regular conversations with our clients, we always stress the longer-term outlook for our time horizons. And although we do have to report portfolio performance through each quarter of the year, we remind you that it is simply a snapshot in time when we look at the quarter or even yearly performance. Now, as most of us have longer than 10-year time horizons ahead of us, our goals to match them, it is much more important that we focus on those longer-term goals rather than the short-term swings in portfolio value. With that being said, all of our portfolios have bounced back nicely through the first couple of months of 2019 after a very difficult last few months of 2018. Again, depending upon your specific allocations and the level of your portfolio's current investment. However, we think that it is not the end of volatility. And I'll talk to that in a few minutes. But what we are focused on, global stock markets have certainly helped so far this year, but they are still in a downtrend from the highs of January of 2018. We still think that they are vulnerable to retest the long-term bull trend that began back in 2009 because we believe that it will be difficult to see stocks rise in the current economic environment. I'll talk to that in a second. We will be better buyers of global equities at that point when prices come back to that long-term bull trend line. And if it should hold, we'll buy more. If it shouldn't hold, then we'll have a rethink and consider what the next strategy will be for making purchases. But it's still, we got a bit of a ways to go. Well, bonds. Prices peaked in mid-2016. They've trended lower until the very end of 2018, and lower yields and higher prices since then have shown us that bond markets are also suspecting weakening economic growth. And as we know, and Paul, I'll ask you to maybe jump in here, bond markets do tend to lead all financial markets, right?
Yeah, and we've been seeing that for a while, Scott. I mean, over the past 2 months, or maybe even 9-10 weeks now, we've had this rally in risk assets like equity markets. These bond yields have not popped up much. I would have thought they'd be, 25 to 50 basis points higher across the curve, and quite frankly, they're about 10 basis points higher. So I guess what I would observe from that type of price action or behavior from the bond market, the government bond market, is that when an asset or security has a chance to actually do something that it should do. Like in this case, yields should have risen substantially given equities rose substantially, and they didn't. So if equities sell off substantially, I would think rates are going to drop significantly here and bond prices go up. So they didn't perform or behave the way they should have, which I think is a good thing and very telling, as you said, for economic weakness and lower inflation.
Well, and we use safer government and high quality corporate bonds to be a countermeasure to weaker stocks in our balanced portfolios because they tend, as you said, to be inversely correlated.
Right.
Moving, bonds move higher in prices, stocks move lower, but at the same time pay us interest income to hold on to them. So generally, what we would classify as a reasonable hedge. Well, bond markets, as we said, also give us insight to the broader economic situation. And when the yield differential between the short, medium term, and long bonds, the 2, 10, and 30-year bonds, when that differential narrows because the central bank, in this case the U.S. Federal Reserve, has been raising rates to fight what they would perceive as inflationary pressures from a growing economy, historically it has predicted that a recession will soon follow. So on the chart, when the gold, green, and purple lines converge, the blue shaded area soon follows, and that blue shaded area is historically the recession. So as we've also talked about, we are very close to the end of the most recent economic cycle, which started back in 2009. So a recession would not necessarily be something that would surprise us anyway. We know that stock markets historically have not done well in recessions. So while the U.S. economy has been expanding with the Trump administration, tax cuts, increased spending, the U.S. Federal Reserve has been tightening policy by raising interest rates to a point now where a number of us in the camp that expects that this has been an over-tightening think that will have some significantly negative impacts on the U.S. economy going forward. And already, as we look into the first quarter of 2019, the latest estimate from the Atlanta Fed is for only a 0.3% rate of growth, which is significantly lower than, as you can see, the consensus. So something that we're watching very closely, but something that certainly plays into the camp that we are and the thought process for investing from our perspective. Corporate earnings estimates have been reduced because expectations for economic slowing are there, and there has been a diversion between stock prices and those expected earnings. So stock prices have risen while expected earnings have fallen, and that means that stock values have actually become quite expensive again and need to correct lower to provide any meaningful value, certainly from our perspective.
And Scott, you'd probably just add in here as well that, I mean, some of the charts you just shown, it really is kind of odd. I can't reconcile it personally, and I don't think you can either, but it looks like we're getting weaker economic growth, yet stock markets around the world have increased in value substantially here over the last 2 months.
Well, you know, and
diametrically opposed, but
that's a very interesting conversation, and certainly in the conversations that I've been having with some people who are have expertise in all of this, it is the expectation that central banks will move to try and curtail stock market weakness, as when we saw that stock market weakness back in December, the U.S. Federal Reserve all of a sudden paid attention and came out saying that they were probably not going to continue to raise interest rates, and they took a more dovish stance to it. Again, this tends to move away from what the central bank's mandates are. The mandates for most central banks are inflation and controlling inflation, whereas and the U.S. Federal Reserve has a dual mandate: inflation and unemployment. Well, unemployment is at its lowest in a long time. So I find it difficult for the Federal Reserve to actually start to lower interest rates, given the current economic picture that is in their mandate. And I think that is the camp that where the expectations of lower interest rates coming from the Federal Reserve have pushed stock prices up. I think that's a mistake.
And we could show a chart maybe in a blog or next month, but these central banks, the Fed, the Bank of Canada, obviously cut interest rates, yet you'll notice the performance of the S&P being very substantially negative as we move into a recession. So I think it's ill-founded to be buying equities at these levels with the expectation of monetary easing coming forward, because it's going to come when we hit a recession.
Yeah.
But stocks are not going to perform well.
And that's what makes the market now. Certainly a school of thought that is buying equities. I mean, they're pushing prices higher, and they have been. And although we find that obviously we're not inclined to be buying because we don't see the value in it. In Canada, well, on Friday we saw Canada's latest GDP numbers, and they basically showed zero growth for the last quarter of 2018. That will put the Bank of Canada in a pretty difficult spot. They've been wanting to continue to raise rates, as had the U.S. Federal Reserve. The one interesting, if you look at this chart, you've seen declining Canadian GDP and continued rising Bank of Canada rate that is somewhat counter to what has been happening in the United States, which I think, Paul, you can agree or disagree on this, but I think that puts the Canadian economy in a significantly more precarious situation.
Oh, without doubt. And, it's part of the reason why we're long some U.S. dollars versus Canadian dollars. But I was going to add too, Scott, that, the past, Canada reports GDP numbers on a monthly basis, unlike the U.S. that reported on a quarterly basis. So the last 2 months reported in December and November were both negative 0.1 on GDP growth. And the last 3 of the last 4 months reported were all negative. So technically, a recession is 2 consecutive quarters, not months, but quarters of negative GDP growth. But if you look at it in Canada, we're pretty darn close to the first quarter of negative growth.
Well, again, too, because the Bank of Canada's mandate is inflation, and inflation is actually below their target, I would see it feasible for them when they meet tomorrow to actually be cutting interest rates. But I would be a big outlier in that. I don't think anybody out there is really calling for that. But I could see a good argument for the Bank of Canada to actually start to cut interest rates as opposed to just stop raising them.
Yeah, well, you wouldn't be alone out there. There's a few others thinking that, but I don't think that'll happen yet. But well, it soon come.
Yeah, it's certainly right now not in the main school of thinking. But anyway, you mentioned the Canadian dollar, and I'll let you talk about it, but it is one of our more significant positions, or actually the U.S. dollar against the Canadian dollar is one of our more significant risk positions in our portfolios, and maybe you'd like to talk a little bit about that.
Yeah, just to make sure people are looking at this chart correctly, this is the U.S. dollar versus Canada. So when the green and red bar chart is moving higher, that's the U.S. dollar getting stronger, the Canadian dollar getting weaker. So it's sort of inverse to what you typically hear on the radio, financial news, or on TV. So we are long U.S. dollars, and obviously that has helped our portfolio, as you can see over the past year or so. It's gone from around that 120 level up to today at 133.5 level. So part of our methodology here for owning some U.S. dollars is it's an excellent passive hedge to the riskier assets in our portfolio, like any equities we own, or even corporate bonds are considered risk assets, less volatile than equities, but nonetheless a risk asset. When there is a big risk off period, when people sell risk assets like they did in the the fourth quarter of 2018, there's typically what's called a flight to quality or a flight to safety. And the U.S. dollar is a beneficiary of that flight to quality, as are government bonds. They rotate out of risk assets like equities, and they rotate into risk-free assets like government bonds, but also the U.S. dollar. The other part of our thinking in the U.S. dollar, which people just picked up on the previous slide, is the Canadian economy is weakening. The Bank of Canada meets tomorrow, and they are, hopefully, if you're right, Scott, they're likely to make comments that they are a little more concerned about the state of the Canadian economy here. We've had a big pickup in Canadian oil, and it's caught, well, not right back up, but the differential between WTI US oil and Canadian heavy oil especially has moved from roughly $50 differential or $45 differential to almost 10 today, which is shocking. But those are short-term curtailment issues or short-term curtailment solutions that have come in Alberta, and they're going to run their course. And I don't think crude by rail is going to pick up the differential. And quite frankly, the other thing that will affect the Canadian dollar here is the political situation in Canada. And rightfully or wrongfully, and not to make a political comment, but since the Liberals have been in power, the Canadian dollar has weakened since roughly 2015. So we'll have to keep a close eye on the political situation in Ottawa right now, and then also, more importantly, going into the October election. If it's even in October, it could be earlier, who knows, we'll have to see. But that is obviously a fluid situation, and it can affect the Canadian dollar dramatically.
All right, that's great. Thanks for all that insight. That's, as we said, that's a significant risk position we do have in the portfolio, and it's great to get your commentary. All right, well, that's it for our monthly video. Certainly, thank you all for taking the time to tune in. If anybody does have any questions, we are always available. Please do not hesitate to get back to us and ask any questions. Interestingly enough, I've had some conversations with some of our clients recently about the Raymond James website. People are raising issues with just the fact that it's a little bit dated, and they might like to see some updates and a little bit more robust online portal. So if anybody has any insight or anyone wants to throw anything into that conversation, please feel free to email me, and I'm more than happy to send on those commentaries to Raymond James Correspondent Services, who do provide us with the back office services and that particular website. So just something interesting. Anyway, that's it for our monthly video, and we'll be back the beginning of April with another one. Until then, y'all take care.